The biggest risk to your cost of living was never inflation. It was never interest rates. It is something much more boring, something called the carry trade unwind. You have likely never heard of it, and that is exactly why nobody is paying attention. If you are wondering why your grocery bill is still brutal, even though the news says inflation is falling, you aren't alone. If you're confused why mortgage rates won't drop even when the Fed cuts rates, or why your paycheck buys less every month while experts say the economy is strong, the answer isn't in Washington. It starts in Tokyo. Hi, I'm Penny. Here is what the big banks aren't telling you. The cost of your rent, your car, and your food is being held hostage by a financial system built decades ago in Japan. This isn't just another talk about rising prices. This is the real structural reason why things feel permanently broken for your wallet. For 30 years, Japan kept interest rates at zero. This allowed big investors to borrow money for free and spend it in America. This carry trade pumped trillions of dollars into our markets, keeping things stable for a long time. But now that system is breaking. I am going to show you exactly how this works and, more importantly, what to watch so you aren't blindsided. To understand why your life feels so expensive today, we have to look back at what happened in Japan in 1990. To understand why your bills are rising today, we have to look back at 1990. At that time, Japan was one of the richest nations on Earth, but they were living in a giant financial bubble. Everything from their stock market to the land under their houses was priced way too high. Suddenly, that bubble popped. Prices crashed, banks struggled, and the entire Japanese economy came to a complete stop. The Bank of Japan had to do something drastic to save the country. Their solution was to lower interest rates to nearly 0%. The idea was to make borrowing money so cheap that people would start spending again. But here's the thing. They didn't just keep rates low for a summer or a year. They kept them at zero for 30 years. While Japan was trying to fix its own economy, the rest of the world saw a massive opportunity. Professional investors realized something amazing. They could go to a Japanese bank, borrow millions of dollars in yen, and pay almost no interest on that loan. It was basically free money. Once they had this cheap money, they didn't keep it in Japan. They moved it across the ocean to countries where they could earn a profit. They used it to buy American government bonds, invest in big tech stocks, or even buy up real estate in U.S. cities. This process is what we call the Japanese yen carry trade. Think of it like finding a bank that gives you a loan at 0% interest, then taking that money and putting it into a savings account that pays you 5%. You get to keep the 5% difference for doing almost nothing. For 3 decades, this was the smartest play in the financial world. It was a massive, quiet engine that pumped trillions of dollars into the global economy, making everything from mortgages to business loans feel cheaper for us in America. It worked so perfectly for so long that people forgot it could ever stop. But as I'm about to show you, when the foundation of free money starts to crack, the cost of everything else starts to shake. To see how this works in the real world, I want you to meet David. David isn't a famous shark on Wall Street, but he manages a lot of money for things like retirement funds or large banks. For a long time, David had a favorite way to make money that felt almost like a magic trick. First, David goes to a bank in Japan and borrows 1 billion yen. Because Japan wanted to help its economy, they only charged him a tiny interest rate, like 0.1%. Next, David takes that yen and trades it for about 6.7 million US dollars. Now that he has American cash, he puts all of it into US Treasury bonds. These are basically loans to the American government that pay him 4% or 5% in interest every year. The math is simple but powerful. David is getting paid 4% by the US government, while only paying 0.1% back to Japan. He gets to keep the 4% difference, which is about $268,000 a year. To David, this felt like free money with very little risk. He pays the Japanese bank their tiny fee and keeps a huge profit for himself, but David was not the only one doing this. Thousands of other investors, big banks, and even entire countries were running the exact same play at the same time. This trade became so popular that it grew to an unbelievable size. By 2024, experts estimated that between $4 trillion and $20 trillion was tied up in this system. As long as the math stayed the same, the trade just kept growing bigger and bigger. It was a giant cycle of borrowing cheap money from Japan to spend it everywhere else, and for a long time, nobody thought the party would ever end. The reason David and all those other investors felt so safe was because of one big assumption. They believed that Japan would keep its interest rates near zero forever. For this plan to work, the spread, which is just the gap between the cheap loan in Japan and the profit in America, had to stay wide. If borrowing stayed cheap, the money would keep flowing. For 34 years, that is exactly what happened. From 1990 all the way to early 2024, Japan was very predictable. Their economy didn't grow much, prices didn't go up, and their central bank promised to keep money cheap. Because of this, the Japanese yen was seen as the most stable tool in the world for borrowing. It was a sure bet. People stopped worrying about the risks because the math had worked for over 3 decades. But in the world of money, forever rarely actually means forever. In March 2024, something shifted that shocked the global markets. For the first time in 17 years, the Bank of Japan decided to raise interest rates. It was a small move, but it sent a massive message to the world. The era of guaranteed free money was ending. The foundation that trillions of dollars were sitting on had just started to move. And as any mentor will tell you, when the foundation moves, the whole house starts to creak. Things went from quiet to chaotic on July 31, 2024. That was the day the Bank of Japan raised interest rates again, and they did it much faster than anyone expected. It was like a sudden earthquake in the financial world. The reaction was fast and scary. Almost instantly, the value of the Japanese yen shot up. Remember our friend David? This was terrible news for him. Because the yen was now worth more, the money he borrowed was suddenly much more expensive to pay back. That easy profit he was making disappeared, and his safe trade turned into a massive debt. David and thousands of other investors just like him all got scared at the exact same moment. They didn't just stop trading. They panicked and hit the sell button all at once. The results were historic. In Japan, the stock market crashed by 12.4% in just one day. To give you an idea of how big that is, it was the worst drop they had seen since 1987. Within 3 days, the American stock market felt the pain too, with prices dropping sharply. Markets became so shaky that the levels of fear were higher than anything we had seen since the start of the COVID-19 pandemic. This wasn't just a small mistake or a temporary dip. It was a loud signal that the old rules of the game were officially broken. The free money system was coming apart, or unwinding. This was only the beginning of a much bigger shift. And as you are about to see, when these big investors scramble to pay back their Japanese loans, it is your wallet that ends up feeling the squeeze. This is the part where the global drama in Tokyo starts to hit your kitchen table. When big investors like David panic and leave the carry trade, they have to sell off the things they bought with that borrowed money. The first things they sell are U.S. government bonds. When everyone sells bonds at the same time, the price of those bonds drops. And in the world of money, when bond prices go down, interest rates, which experts call yields, go up. This is exactly why your mortgage rates and car loans are staying so high. Even if the Federal Reserve tries to help by cutting their own rates, these global bond yields keep pushing upward. Everything from your credit card interest to a loan for a new truck is tied to these bonds. Because the free money from Japan is disappearing, it's getting more expensive for everyone else to borrow. The stock market feels the pain too. For years, that cheap borrowed money acted like extra fuel for stock prices, especially for big tech companies. Now that the tide is going out, that extra fuel is gone. As economist Robin Brooks pointed out in 2024, this isn't just a small problem for banks. It's a system-wide shift. When the Davids of the world pull back, the stocks that used to soar suddenly face a lot of pressure to stay afloat. Finally, we have to talk about your home. Because those bond yields are high, mortgage rates stay high. This creates a lock-in effect. People who have an old mortgage at 3% refuse to sell their homes because they don't want a new loan at 7%. This means there aren't enough houses for sale, but people still need places to live. When there is low supply but high demand, prices don't fall like they should. Instead, they stay stuck at prices that most of us can't afford. You see this every time you check a real estate app and wonder why a basic house costs a fortune. It's not just bad luck. It's the ripple effect of a global trade coming to an end. If you watch the news, you probably see experts obsessing over every word the Federal Reserve says. Everyone is waiting for the Fed to cut rates, thinking that will solve our problems. But here is the truth. Most people are looking at the wrong lever. The Fed mainly controls short-term interest rates, which are like the small gears in a clock. But the big things in your life, like your mortgage, your car payment, and the cost for a business to grow, are tied to a different gear called the 10-year Treasury yield. In late 2024, when the Fed finally started cutting rates, many people expected their monthly payments to drop immediately. But they didn't. In fact, in many cases, they stayed exactly where they were, or even went up. This happened because the 10-year yield is driven by global money moving around the world, not just by what happens in Washington. While our leaders were trying to lower costs, that massive carry trade from Japan was still falling apart. As those trillions of dollars moved out of the market, it kept the pressure on, keeping the interest rates you actually pay much higher than they should be. It is important to understand that the Fed can control what banks charge each other overnight, but they cannot control a $20 trillion global trade. They can't tell a hedge fund in London or a bank in Singapore what to do with their money. What actually drives your cost of living isn't just a speech from a government official. It is the quiet decisions made by professional traders in Tokyo and London. When they decide to sell their positions overnight, your mortgage rate feels the heat the next morning. If we want to see what is coming for our bank accounts, we have to stop staring at the Fed and start watching how the rest of the world is moving its money. So, what happens if this trend keeps going? It is a serious question because there are still trillions of dollars waiting to be moved out of this trade. If the unwinding continues, then long-term interest rates will stay high, no matter what our own government does. This means that mortgage rates could stay in the 6% or 7% range, for much longer than the experts on TV want to admit. For millions of regular Americans, this keeps the dream of owning a home just out of reach. When people can't afford to buy a house, they have no choice but to keep renting. This creates a huge demand for apartments and rental homes. Because so many people are forced to rent, landlords can keep prices high, even in cities where new buildings are going up. It creates a trap where your biggest monthly expense, your housing, never seems to get cheaper. This is how we end up in a very confusing situation. On paper, the official government numbers might say that inflation is low and everything is fine. The headlines might even tell you the economy is doing great. But in your real life, the cost of housing, your car loan, and your credit card debt stays brutal. It feels like you are being told one thing, while your bank account is telling you something completely different. The official numbers say you're doing fine, but your balance at the end of the month knows you aren't. Now you finally understand the hidden machine that is making it feel that way. Here is the one sentence that ties everything we have talked about together. Your high cost of living isn't just about local politics or basic inflation. It is being held up by the slow-motion collapse of a 30-year global trade that most people don't even know exists. While everyone else is arguing about the small stuff, you now see the giant machine moving behind the curtain. Going forward, the most important thing to watch isn't whether the Fed cuts rates by a tiny amount. Instead, you need to keep an eye on what the Bank of Japan does next. Their decisions will determine how much more of that carry trade money is forced to leave the market. If you want to know what is actually happening to your money, stop looking at the scary graphics about grocery prices on the news. Start watching the value of the Japanese yen and the 10-year Treasury yield in the US. Those are the real signals that tell you where interest rates and your bills are headed. Most people are just talking about the symptoms of the problem, like the price of gas or eggs. They are reacting to the world as it happens to them. But because you understand the mechanism underneath it all, you are in a different position. You aren't just guessing anymore. You are seeing the move before it fully happens. That is the secret to building wealth and staying safe in a shaky economy. It's the difference between being blindsided by a storm and knowing exactly when to head for cover. If you want to understand the next big move before it happens, make sure to subscribe. This is the kind of deep analysis we do every single week to keep your future on track.